Thanks everybody for being here. This is the follow-up on our algo system and also trades and what's been going on in the world. And I just wanted to make sure that this is I'm going to go through some trades and develop this enhanced product for those that were interested. And we're going to go through that as well as a few other little neat items. And the craziness of what I always generally do is to look at market conditions as they're occurring rather than canned I guess examples from 1944, because quite frankly we are in a completely different world, man, than we were not just 6 months ago. I mean, even 6 months ago, we're in a different world in a lot of different rationalizations. But before we begin, please take a moment to read this risk disclosure statement. All right. So this is one that I had last week, and I sent an email out about the volatility, and I had actually a couple people respond to me in a term I'm not used to, because maybe I think they missed what I was pointing out to. What I was pointing out to was just the fact that we had, even in 2015, I wasn't referring to any administration, I wasn't referring to anything other than market conditions. So let's just get that straight. If you take a look at Wells Wilder's average true range, which can be found virtually anywhere on any platform, I'm not reinventing the wheel. I am not recalling something of what it is. I am just saying using Wells Wilder's average true range. Now, what is the difference between what we define as true range and average true range? Well, if you got an average in front of true, then that means you're averaging out the daily ranges. And what is the daily range? It's not according to Wells Wilder, the high and the low. It's the greatest of the range of the high and low versus the prior day's close. So if you have a gap up in a small narrow range, and that's the range today, versus a range like this, and that's yesterday's close, then the actual true range is the difference between the high and the close. So that's where we get the defined difference of what the true range is. When we're taking a look-see of a 20 period true range, and at this point in time it was, in October, that's 2 years ago. I just wanted to do a look-see back 2 years ago. What kind of trading environment were we in? Even in 2015, when we went through this decrepit sideways range, and you can clearly see on average, even at the worst, we were at around a 22 handle in that time period. At the very worst part of trading, you guys may have remembered, it was like, man, this is so boring here in the summertime, right? From May into June. This is like a slice of time in 1 month where the worst case scenario average true range of the E-mini S&Ps was 22 handles. So why do I even bring this up to you? Because when I made a comment about we are in a totally different environment right now, let me point out a couple things. First and foremost, and I'll get into this page in just a second, but let's go over to looking at the true range of some of the markets, and I'm just going to insert a blank row here, and I'm just going to put ES, because apart from today, which we finally had almost a 19 handle, well, we did have a 19 handle range at the end of the day. Look what the true range was and what we've been dealing with for pretty much the last 2 weeks. 9.84. Yesterday, the true range averaged out 9.49. Gang, that includes from 6 p.m. open at night until the close at 5 p.m. the next day. So when you say, where's the volatility in the market, it's not just when we talk about volatility in terms of the VIX, we're talking in terms of volatility of ranges. And so that has a lot to do with how we trade the market and our holding periods now. So the holding period of what we have to look at is totally different, because now in order to get the same, maybe off a trade signal, the same amount of money, we have to have a longer holding period. Now, here's another interesting aspect. I was talking about this in our trading community today, because when the markets, and I'll give you a quick look-see in the overall aspect of things today, where we stopped and how we stopped in the market with these, the 60-minute charts, and I'll show that to you in just a second. It wasn't indicative of the market crashing, number one, okay? And so if it was going to roll over, we needed to see a breakdown, and I will put that up for you right now. Let's cover it one step at a time. So in the S&Ps, this is a daily chart. What we need to see, it was ironic how we had the weekly person's pivots where we stopped dead on a dime, but what we need to look for is a close underneath the 2539 number. I don't know if you guys, it might be hard to see it, but it's until we actually get a different market condition, this is what we consider, or what I consider, to be what's called a last conditional change candle in the marketplace. And so when we get these white line in the sands, so to speak, or we draw against these little lines here, if you notice, we traded today below that support, and this is what we call a last conditional change. So if anyone's bought my book, if you bought the one book with my picture on it, which was published about 2005, I think it was, 12 years ago, there's a couple concepts in there that I wanted to bring up, because, again, that book I wrote back in 2005, so it's 12 years old now. We talk about ATRs. I think everyone in the planet that's a trader needs to look at volatility, expansion, and contraction of pricing. And so we look at ATR. Back in those days, I actually used the ATR as a function of defining profit targets. And if you do have the book, you'll find that that I wrote about that on a 10-day. Back then, I still use a 10-day. I used a 10-day of the ATR. You can find that referenced on page around 264, 263, something like that. But this is a concept here. It was a unique feature function of my market observations that I classified as a last conditional change. What we did with that concept of a last conditional change, it helps to define a market breakout and a structural move that acts as, until it's violated, a support in the market. And as you can see, we actually have it kind of color-coded, literally, where we call it a line in the sand, and it helps to define the market condition. And so, while yesterday, and I'll share this with you as well, in the month of October, so let's just take a look at the month of October. Since we opened in the month of October, the first 5 days, 1, 2, or 4 days of the market. So this is the first 4 days of the market of October. Since the first 4 days of the market of October, the S&Ps really have gone nowhere. They just haven't done a lot. And in fact, what we have done is we've had subnormal 10-handle days, which has reduced the average true range to near sub 10. So we've been through a period this year where we go either breakout and then nothing happens, and we get a couple moves, and then we break out and then nothing happens, and then we get a couple moves. And as many of you are all aware, we've also been through what we call a massive sector rotational grind in that has affected the various stock indices. Now, this is important when we kind of define what this market's doing, because when we all look at the headline news and it says, or you look at your 401k, or you look at your portfolio and you say, gee, this is doing great. When is this party ending? And so what the funny thing is that certain times of the year, or this particular year, we had an explosive move in the Russell, as it was here, and I'll share that with you right now. And you want to talk about, it's not just a sector rotation, it's indexing rotation. So when we look at this market, and I know I gave this out the last time, and I just want to reaffirm this and share with you this, because it's kind of what we have to deal with, and I don't think it's going to end any day soon. We went through a blistering upside breakout trend with a significant improvement in volume, and of course the advanced decline or breadth of the market had broken out. It was very strong in the market. That was, at least for this market, being the Russell, the small cap. But the funny thing is, since October, going right up down the list, the Russell's actually kind of been forgotten a little bit because it had such a great, outstanding run at the end to the middle of September. What took its place? Look at this, gang. The Dow Jones Industrial Average. So all that we saw happening, and look what happened to the Dow. The Dow, since October, did nothing but go straight up. So since October 1st, the Russell's gone down and the Dow's gone up. I wouldn't call the Russell going down. I would call it sideways, right? So we've seen indexing rotation in the marketplace, or stocks that affect these different indexes. Tools that have helped have been, by all accounts, advanced decline analysis and, of course, volume. But trading strategies and dealing with overall markets, while most of us trade on a day-to-day basis the S&P 500, we have seen this shift in indexing of what we trade and, of course, when we trade. And so what we need to kind of address is, when we're looking to say, hey, we need, as traders, we need the market to move, right? You need the market to move in order to get some kind of an idea of what's going on. Without movement in the market, things get kind of dull. If it's up every day, people get complacent. No one wants to buy options. And if there's no buying of options, then there's who wants, if I'm selling premium, I got to command a little bit more money for the risk I might take by selling premium to a buyer. But if there's no demand, I gotta lower my cost structure or my pricing of what I'm offering. So therefore, we start to show a decline in implied volatility, and that means options become a little trickier to trade at times. And so there has been, based on the diminutive movement in velocity, the pace of price change, a diminutive move in the trading ranges. It has kind of altered the structure of how we trade. Another thing that's happened is we've taken over, or at least in new products to trade, between these leveraged ETFs that, I mean, my list of leveraged ETFs is growing by the hour in this market in what we can trade and the different shifts of what's happening. The other week or last week, I made a tweet out about Labu. We had a sell signal in the 3-time ETF. There's the sell signal in the ETF. But, you know, today it stopped going down. And I would suspect that unless we close underneath this 80 mark, that round number right now, unless we closed underneath that round number, my guess is we might see, and I'll talk about this to our community tomorrow, we might see a potential upside surge one more time in the biotech space. So why would I say that? Well, first and foremost, the decline that we just saw was pretty muted. We did get a sell-off from that signal. I mean, it actually went down, you know, 7 handles, 8% or so since the sell signal over the last week. But we've come into an area of old, what I call support area. And, you know, when we took this little decline here, we haven't really seen a huge shift in downward pressure of volume. So I would be hesitant to say that this is that white line in the sand up here again, okay? And this is a detrending moving average. If we get a daily close over that white line in the sand, I think we resume the uptrend. So 2 things that I would have to say that the market has been in a situation where we've seen sector rotation and rotation and rotation, and yet when one sector gets, you know, taken down to the woodshed for a few days or so, all of a sudden we see it recover, and that has been kind of like the whole theme this year. Here's one of the things that also has been a new big-time shift, and a lot of you are been on this pretty much all year, and it is the volatility products, and we have a little bit more here, the TVIX, UVXY, and looking at the VIX itself. Now, I think 2 days ago, what I did in using my lifetime, this is the person lifetime package. This allows me, this radar screen with TradeStation allows me to see a lot of stuff, and my signals, which we've programmed in, it allows me to look at my person's market catcher as far as relative strength. I can see immediately a lot of things. And one of the things that I noticed on the VIX as I put this out, and let me change this over to a candlestick because this is kind of interesting here. There we go. So what was interesting in the market, at least to me, which has caught my eye, which we got a small pop in volatility today. It didn't stay there very long. But as the S&Ps have made a newer high, the VIX itself has not made newer lows. The relative strength, now this is not an index to trade, so there's no volume. That's why you have a 0 reading here. But it has been trying to make, and if you were looking at this objectively, you'd say, hey, we got a higher high, we have a higher low, we've made a consecutive series of higher highs and higher lows. That's kind of strange. You would say, hey, I bet you the stock market has gone down. And then with that assumption, you'd be, well, wrong, because here we find ourselves looking at, and I'll get us back up to S&Ps real quick. The S&Ps have rallied. They haven't broken down. So what is it that is going to take this market, and is it just going to continue to go up forever? By the way, this is the person's market catcher. It's a relative strength indicator, and it measures the product versus the S&Ps. The reason it's at 0 is we can't compare the S&Ps to the S&Ps. This is the volume indicator. And ironically, we are today, as you can see, this number here, it's 254. It's right there in your scopes of viewership, 254.82. That's kind of a very key critical number. And I think what we would be looking for is either we're going to, if this thing ever does give it up, right, or starts to see a correction, we're going to have to see at one point in the future, we're going to have to start to see something happen magical to these 4 points of interest: open, high, low, and close. Something magical is going to have to happen. And it's got something to do with the close as it relates to past price action. We're going to have to start closing below uptrend of moving average. We're going to have to close below past or prior lows. And unfortunately, one of these days, we might just get one of these tall red candles, and then, that's the end of it. But at this point in time, I would have to say that the market at this juncture, tops take longer to form than bottoms. And as we were starting to rise here, we're at the very least, all I could tell you about the market's condition based on today's price action is that we uncovered some supply and we uncovered demand. There's supply up here because we had a reaction to the downside, and there was demand here. And that's what we're going to have to see, how much of a struggle or volatility increases. And there's an old trader's term. Volatility marks tops and bottoms of the market. For the first time, we've seen an expansion of the volatility of these daily ranges. Finally, we got almost a doubling effect of our average true range. So in the next week or so, or the next couple days, what we want to look for is that we want to see, number one, we want to see if the true range starts to appreciate and stay within above its 10-day history. And if that's the case, that increases the likelihood that the market is demonstrating nervousness and complacencies coming out of the market. I just shared with you that situation looking at the VIX. The VIX was rounding itself out, as the market is going up. That's kind of something that most of us would not say it goes hand in hand. Usually if the VIX goes up, then we see the market going down, and that's not the case. But we are seeing a little shot of volatility. Now, it's ironic that we just started noticing that the VIX has been popping up, and then all of a sudden it's the first day that we got a pretty wide range trading session. So that's very important, and that's good analysis. What does that also do for us? It also puts us on guard, and then I wanted to share with you guys, as we get into system trading, how we need to adjust for volatility, because that's the whole point. If we're setting ourselves up for narrow ranges and narrow ranges and narrow ranges, and all of a sudden we go through a period of expanded ranges, well, now we got to set our sights on a different style of trading. Now we have holding periods that will shrink down because we're going to get expected moves faster, right? If you have narrow ranges, it takes longer for the market to move, to get from point A to point B. If we have expanded ranges, it takes a lot quicker for prices to get from point A to point B. I hope that made sense. Now, I'm going to cut through the chase, and I'm just going to share, because I know we've showed some of, I think, as far as trading, what we've seen in the markets, as far as a lot of you guys with your biggest frustrations. Part of this year we've seen stuff like the markets start to move, and we want to get in, and we put a bid in the market, and then it just takes off without you, right? We've also been seeing this concept. The market's been flat for hours, and the minute we walk away, that's when a trade we wait for is triggered, and we're not in. I mean, that's been a part of this year's, because of that narrowing range, because of that contraction, or possibly this. You get in a trade, you get stopped out, you get in again, you get stopped out, and then you quit, and then you say no more of this, and at the one time you say no more of this, I'm not in. I mean, those are frustrations that we all as traders deal with, and are those real frustrations? And the answer is absolutely. And I'll share with you what that, and let's take a look at this one more time. Markets move, you want in, you miss the bid, and a market takes off without you. You place a bid, you don't get filled, market moves without you. Markets are flat for hours, and the minute you walk away or go to the bathroom or say, I'm going to get something to eat, I can't sit in front, my butt hurts from sitting in the chair, and you're not in. Or you're in and out, and you lost money and you're no longer in the trade. Is that a real situation? And the answer is absolutely it's a real situation. In fact, how real is it? It happens a lot. Let's take a look at this. This is a product, the VXX. I often share this with you. This is our VIX product system. And here's a situation that I think is pretty unique. When you see a blue line, that means it went short and it got out and it took a profit. If you see a red line, it means it's a loser. This case, it got long and it got out. It got short, it got stopped out, but then it rides the trend. It went short again, it got stopped out, and currently it went short again. But here's the equity curve on this product. And how good is that equity curve? It's pretty good. It's gotten, just recently we flatlined. We've had a couple flatline sessions, but the performance summary is pretty decent. For a lot of you guys and ladies and gentlemen who understand system trading, it's not bad. Sharp ratio over at 50 right now. The RNI index is off the charts, 1200. Drawdown factor, pretty reasonable for the amount of equity needed to trade, and its position sizing. So it's a pretty stellar, robust product or trade signal. As far as how many trades, this goes back since its inception of January of 2010. It started in 09, but it wasn't really tradable until 10, and that's the overall performance. Would this frustrate you to have a couple losers in a row and then say, forget it, I'm not trading? A little losers too, by the way, and then miss the big trend, and then give a little bit of that profit back, right? I mean, how many people, but that's the cost of doing business. And then you sit around all day long and you wait for the trade signal and you're not there. That's part of the reality of trading. You know, I wanted to show you guys, this is something also that crude oil. Now, this is kind of a unique in the sense that this is a 60-minute trade on crude oil. I don't know if you guys, if there's a lot of crude oil traders out there in the community right this minute, but crude oil has been, it's been an interesting year for crude oil, right? I mean, if you take a look at the volatility, I mean, it looks like an umbrella. It just hangs down and it comes back up, hovers, drops, does nothing, hovers. It's starting, to me, if you take a look at this 60-minute chart, it's starting to look a little toppy there, right? It seems to me making kind of some lower lows. It's making lower highs. It's having an easier time going down. It takes a lot longer going up here. But the point that I'm trying to make is this is another performance that has done fairly decently this year in its performance graph is pretty, I would say, outstanding, to say the least, but yet it's not 100%. So when I say it's not 100%, this thing's traded over 964 times, so it's, when I say robust, I mean we look for a product over time with lots of numbers, lots of trades, different market conditions, something that we can kind of throw the kitchen sink out and say, is it been taking a lengthy amount of longs and shorts, or is it one big winner, or is it a bunch of, you know, what's the nature of the signals that come in the market? And so this is another example of a pretty darn robust trade system. And I could tell you this, and I'm gonna just cheat with you real quick. I'm gonna switch this format strategy, or try to. Actually, there's an issue. Every time I do that, I have to stop the projection because there is a conflict between, and I didn't mean to do that. Johnny Hill, I'll answer your question. When I say a handle, that means is the market trading at 25.60? Is it trading at 25.61? Because it trades in ticks between points or the handle. So in essence, if we are at 20, if I say the market's got it's a quarter bid and a half, what's the handle? 61. It's 25.61 and a quarter. So when I say 10 handles, that means 25.60 to 25.70, 10 points, not ticks. So that's the difference there. So let me just do something real quick here, gang. I'm going to stop the projection for a second, and I'm going to start the. It does, and here's the key element. See, and there it just popped up. So if I hit this thing format right there, I'm going to change in the person Algo optimizer. I'm going to change the position calc method, which is just this particular system is up this year trading 2 lots. Okay. 2 lots. So I'm going to change this factor to every time we trade, we want to risk $1,000. I'm just going to humor and see what the difference is. I already know the answer, but I'm just going to show you the difference in looking at including a risk factor of $1,000 every time you trade. And as you can see, we kind of enhance a product and make it even that much better. So, you know the old adage, it takes money to make money? Well, that's enhancing positions, or perhaps enhancing a position where maybe if we have the capital to trade it overnight, meaning the margin requirement, and we want to risk only $1,000 per trade, so every time there is only $1,000 risk in it adjusts the position. Notice what it's done here. We've gone from a 2 lot to a 10 lot, a 5 lot, a 4 lot. It kind of alters 8 contracts, 12 contracts, 7 contracts, 2 contracts, 4 contracts. You can see that it automatically adjusts our position based on risk. The signals are the same, but if you have automatically adjusted your positions, you can take a pretty good system and turn it into something a lot better. Anyway, that is part of what we consider to be algo programming at its finest, and what volatility can do for us in low periods of low volatility when we expect lower ranges of the market. By gosh, I need to maybe trade more positions, or that's part of the whole trading concept that's probably been left out of a lot of people's repertoire. Also, looking at the market, now we did this yesterday, and this is just something from this month. This is the E-mini S&Ps. This is the 15 minutes. I want you guys to realize something, that not every trade's a winner. And how do you make a lot of money in a market that doesn't go anywhere over the last, literally, as I shared with you, since October, the first 4 days the market went up. After that, we've been literally, if you look at where the market was from Thursday, October 9th to, let me get my calendar. It was Thursday, October 5th. Listen to me. Thursday, October 5th, the first 4 days of the market. So let's examine that. This is October. So the first 4 days of the market, the bulk of the move for the whole month was right here. Agreed? That's it. That's Sunday night. That's where we were. We had a gap up. All of a sudden the next day, and then Thursday. Since Thursday, what has the market really done? Not a whole lot. So 1, 2, 3, 4, 5, 6, 7, 8, 9, and then today, baby, makes 10. And that's 2 weeks of representative trading that we had less than a 10-point, literally more or less on average, a 10-point range over the last 10 days in the S&Ps. And so, when people look at individual stocks, and individual stocks have gone left and right and all around, the overall market, it's gyrating, going nowhere fast, but yet it continues to grind higher. So short-term trading and algo systems, you kind of take a look at this and you go, I need volatility to make money. Yesterday, and I want to share, this is only something, and we did this for the trading room yesterday, and I want to do it for you guys as well. And I'm just going to show you the strategy performance. It's not a big deal, but in the whole month of October, all right, in the whole month of October, that's all I want to take a look at. I don't want to look at anything. Just show me October. What has the thing done? It's been kind of a BS kind of trading range market. It's traded 14 times. We had now 3 trades on the short side. We had 2 trades and then another one, and that's it. That's it. That is amazing. Why is that amazing? Because the first big trade that it had from a short side came in yesterday. We had a short over here, and it didn't do anything, and it just went sideways, and it ran out of time, and it expunged itself. But what I'm trying to point out to you guys is that we need volatility, and that's where the short position right there kind of got lost in the shuffle. But yesterday's trade, we started to see something that was interesting, at least to us, is that for the first time, we had a low volume rally and a sell signal that we hadn't seen all month. The market had a higher high in the move and had a lower volume reading. And again, it had a pretty decent risk factor, which was up at 64, and then overnight, the position was covered. It currently, and I didn't share this with our trading community because it was after our time, it went in a long position, and so at 54 and a quarter. And that is an area where we need to see if the market's going to come back down. It will break that level by tomorrow. If you're watching S&Ps, 54 will be kind of a pretty important swing zone in the marketplace. I thought I'd, on a side note, bring that to your attention. So what's the point of bringing this information to you? Number one, we are dealing with markets that have a lot of technical bias to them. We are dealing with a little bit more creativeness in the quant and algo field. We're also dealing with a lot of market conditions that are carrying over from the day session into the night session and then into the European session. And I think that that is another issue that we're going to have to, as professional traders and everyone has been addressing, and the retail traders are going to have to address as well. Another thing is enhancing performance. This is Tesla, by the way, and taking a look at different signals. I wanted to share this with you because there is a key word that we like to use. It's called robustness. And when you have a trading methodology and you have something that can develop, whether it's short-term signals that get out quickly, reverse to the long side, how many of us have been frustrated that, you know, you take a short position, you get stopped out, and you're like, you know what, I should get back in there, and you don't, and then all of a sudden you should, and you miss it, you weren't there, and that's your big trade. Or, you know, these are the kind of things that I think that we've been bringing to the general public and to your awareness that while not every trade's a winner, right? It's not every trade's a winner, and you can clearly see there's a little drawdown every once in a while in here. But the overall performance over time is what we're after, whether it's Tesla, the VIX, whether it's crude oil, E-mini S&Ps, or, you know, this thing, which is a emerging market, which is something that I'm not a big fan of myself. But again, emerging market is you know, with the world doing much better in its trading, by the way. I mean, everyone says, hey, the global economy's doing great and everything's rising. There is one thing that I'd be looking for. A lot of people might have forgotten. We're up against a multi-year high. Traders have been in this trade for a long time, gang. A lot of hedge funds, a lot of people around the world have been in emerging markets. And we are right up against this kind of like longer term high. We've got a massive resistance here and a resistance there. You know, against our markets, the relative strength is starting to disimprove on this rally. The volume is starting to show a little signs of weakness. This thing's taken some longs. It's taken a couple shorts. It's not really provided. I mean, it's been a very choppy market over the last number of years. I bring this to your attention because the performance graph, it shows that choppiness. It's not a very fluid market. It's an ETF nonetheless, right? But it still showed some upside, and it just hit a new equity high, by the way, in its performance. What I'm sharing with you is that if this product, and when we start to see, which it's been long, the market, as you can see, it's long right now, this market starts to reverse and it starts to generate sell signals. This is another thing that I think is kind of key critical, is to look at the dynamic structure of its risks and look at its overall performance and say, hey, do I want to trade the short side of EEM, buy some puts, sell some calls, and what are the corresponding markets? If we're all going up together and I start maybe getting some sell signals out of this thing, you know what? That might be a good sign of a market downturn going forward. So we have a lot of different ways of looking at the market, and I know everyone has their own style. What I think is important, number one, is not to just get your own style of trading, but get a quality set of entry signals, exit signals, and define those signals so that it fits to your comfort level of what you expect out of trading. So whether it's day trading E-mini S&Ps to possibly trading options on spiders, here's a scenario here which is kind of ironic in the marketplace. This is a pretty stellar performance in the spiders as well, by the way. Again, it's not performance enhanced by position sized. And what do I mean by that? It's basic off of a $100,000 account. That's it. So it's not, as you can see, it's trading about the same amount of positions. It's not going crazy trading thousands of contracts, right? So you can see that it's all around 400 contract shares each time. And so this is kind of a nice little performance. What I wanted to bring this into focus for was another reason, gang. Got long, got out, and yet because of the risk, now this leg up to the upside, if you notice 1, 2, 3, 4, 5 days, it doesn't capture that leg to the upside. Is this a bad system? No, it just means that the risks programmed in to the individual user, it didn't meet the criteria of getting long. It took the profit and that was it. And so it had a short position, it got stopped out, it got long, and it got out. And guess what? In the spiders, flat in this time frame. So the point I'm trying to make is this. Depending on the market, depending on your risk tolerance, and knowing the fact that this marketplace is giving something for everyone, whether it's inverse leveraged ETFs, there is going to be times where, first and foremost, you might miss a trade. There's going to be times where you're going to have, and maybe you've already experienced this, that you're going to have losers along the way. And not every trade's a winner. But what we want to do is define the risk factors and be able to say, okay, didn't do all right today, but it's the performance over time. That's the key. That's the element, the performance over time. Maybe this will sum things up, performance over time. Periodic returns, right? What is the situation on a monthly basis? What is the mark-to-market basis on an annualized basis, right? So is there a decent rate of return on a monthly basis on equity? That's consistency, not what happens on a everyday or a weekly basis. If you go weekly, you might get a little upset. 1 week's good, 1 week's bad, but overall performance, you want to see your month-to-month accumulation of profits improve. So I'm here to tell you, gang, trading is about being aware of what our environment is giving, what the markets are giving us. And that's one of the key elements. I hope today I wanted to bring that to your attention because that's exactly what this slide is about. What this market has been doing and delivering. The market is delivering profits. The market is delivering trade ideas, but it's delivering it, I think, in a different way in which it used to give it to us. You know, we used to be able to see a 40-point move, handle that is, a day. Remember last year, 2016, we woke up every morning. It was like, oh my God, S&Ps are down 40 handles. Oh my God, the Dow's, you know, up 600, down 600. We're not getting that. We're getting a different area of volatility in the markets. So I think that's kind of like what this whole concept of what we would be trying to present to people in this Algo and quant product that we put out, and having the ability to get something close to a prop firm's trading system. I mean, that would be pretty nice if we all had access to a prop firm's trading system. I mean, we'd have our own PhD kids over there programming things for us, you know, for a good systematic entry and exit, as well as holding period and things of that nature. If we had that, I'm thinking, you know, it would maybe make your job a lot easier. And since this is that era of market events, this is what I think is amazing about not just trading systems, but a market environment that's based on trading systems, because that's what I think we are entering now. You know, every day that goes by in the marketplace, gang, and I give out our trading room price level. If it doesn't break, the market goes up. If it breaks down of those support levels, the market has big moves. And that's a part of that last conditional change that I talked about. So we've tapped into, I think, some really neat algos that seem to be in sync with the computerized trading world right now. And obviously the results of different markets speak for themselves in the sense that whether it's Even this, I mean, I think Amazon, you know, just taking a little look-see at Amazon over the last, just this month alone. Talk about counterintuitive. I mean, couple bad trades, big long trend, a quick short, gets in long, a bad trade, a little mini bad trade, another 3 in a row, market doesn't go anywhere, gets short, and then for whatever reason covers the position this morning, which we announced to the trading room. I mean, nice little pickup in overall equity on non-leverage. Of course, this is Amazon. Many people find this to be maybe a better trade in options, but you know, or taking signals and using them as far as options. Either way you look at it, the market is giving a lot of different ways to trade now and products like we've never seen before. And that's what's kind of interesting and why I think this is such a phenomenal product for people, because the option markets have been good, but we need more volatility in the marketplace, I think, overall. Not just on individual stocks when earnings season comes out, right? That's part of an issue. And I think there's all different ways to trade in the marketplace, but for more people than not, we all kind of agree we need more volatility, or we need to kind of enhance our trading performance somehow. And that's what the ultimate, this Algo Optimizer program is all about. This thing's taken over 8 years, and I've been working on it for myself and doing this. One thing that's really cool about this is that we have stops, risk management defined, trailing stop features. We get to choose our own position size based on capital, leverage, or per trade risk. Can you imagine? So as I was kind of sharing with you, how do we enhance performance on the same signals? This is very powerful. This is so powerful, I think, in the right hands, that someone wants to take the time to learn to have this and say, hey, I want to trade with a defined set of rules. I want to have something that I can trust and know what are my average losses. How many average losses do I have in a row? Can I choose how many positions I want to be in? I mean, some people rent trade signals, and I'm sure you may have rented someone's signals in the past and it works for a little while and they fail. One of the reasons they fail is because volatility changes, and you have control over optimizing when that volatility changes. You also have time that, as I've also alluded to a couple times tonight, is that when ranges narrow, what your holding period in the trade has to change too. Or if you max out, then get me out of this trade, because it normally doesn't take that long to provide or produce that type of profit. So holding period's kind of important. And that's why this has been, for the retail trader, it's a dynamic product. And this is part of what we were just sharing with you since the last time we were together. I mean, obviously this is when last 3 weeks ago, the profit potential has gone. Actually, the profit has increased. This was, I'm trying to think, this was at 38.34, and the date looks like it got cut off, but I can go back and I'd like to take a look at that. 38.34 was over here, and we've seen an increase in the performance. So already, and it's, you know, big bulk of profits on those little trade right there. So looking at markets, I mean, as we get through time, defining profits, again, even with this performance, looking at for the month, whether you're trading a 15-minute, a 5-minute time period, you know, having something that can say, hey, I want to get in on certain trades, I know what my risk is, I know what my profit target is, and having that all kind of defined with a series of information in front of you that you can say, you know, I want to trade that. And by the way, turn it on. And with Tesla, for example, if you're trading stocks, okay, maybe I don't want to trade the stock itself, but what I will do is let me know when there's a buy signal, where my stop is, what my main profit target is on that trade. That's what these lines in the sand are all about. The only problem that I have to mention about this, all right, if you look at this, this is where your stop goes, there's your entry, how many is it long per your risk, and this is your first profit target, and that's the second profit target. Here's the problem. You go and you say, well, I'm going to do an option strategy. It's long, I'm bullish. Maybe I'll sell some out of the money premium in the next week. This is swing trading, so it should work over the next maybe 3 to 5 days. Great. This is a daily chart, so maybe this is something more of a 2-3 week trade. The problem is, what if the market rallies close to the profit target and it trails the stop and gets you out? So you're going to have to monitor your own system, because that's what we want in a system. If the market comes close to the profit target, then get me out, right? I mean, think of it this way. This is why this is so unbelievable, because sometimes we have a risk, we have an entry, and we have a profit target, and the market goes up, 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 and it comes close to the profit target, misses it, and you know what happens? We're not around, and then yikes, right? Trail a stop. Get me out of this thing. So using a function like this and a system like this that can define your longs or define your shorts, will help enhance on a few. I know we can't trade everything under the sun, but something like this that has dynamic features and robustness to be able to optimize for various markets is incredibly powerful in the right hands, as I was saying. So with that said, whether it's the euro currency, whether you're a Forex trader, whether you're trading stocks, auto-executing this and or not, which you can set alerts. And this is one of the things that I think is very important for traders to realize, is that instead of just buying a black box system, I get to choose when I'm trading, what time frames I like to trade. So all of a sudden you notice that, you know what, the market, the euro currency or the futures or crude oil has been getting a trend over since 2 in the morning to 5 in the morning. You know what, I would like to trade and have the system run from 2 in the morning to 5 in the morning, and if we generate a sell signal, take the trade for me, auto execute that. And you know what? I'm going to go small. I only want to do 2 little contracts every time I trade. So I can choose position calculation method, how many positions, whether I want to trade on an account size. I can choose whether I want to trade per risk, or I want to trade if I want to choose how many contracts I want to trade. I can not only set my time frames, but I can also set my position size. That's what's dynamically unique about this, and having people learn how to use it. What's really cool is that you can not only trade, as we pointed out, to generate alerts, but you auto execute, and then if you want, turn on the confirmation button, so that way a little box pumps up and it says, do you want to do this trade? If yes, hit yes, and then it'll fire off your entry, your profit target, and your stops, and it'll execute it for you. Or you could just say no, and guess what? I'll just trade it manually and use the signals. Maybe you want to cheat and use options instead. That's kind of one of the things that I think is pretty neat about allowing you to see your strategy positions moving forward. So I know there's a lot of people that had said, hey, if I just wanted to rent this, can I just get your signals? And the answer is no, because this is a special product for people to set their own trades, whether you're a 5-minute, a 1-minute, a daily, and a weekly chart trader, whatever your time frame. This is for you to set your own trade system up. Since a lot of trade systems charge a monthly fee, and there's anywhere from $89 to $350 a month that control your position size. So maybe I've seen, and people have told me that they have like a $150 a month and E-mini S&P signals, and you can only trade 1 or 2 contracts. Well, this Algo optimizer allows you to not only custom tailor the sessions you trade, whether you want to auto trade or manually trade it, the quantity you want to trade. So you're not limited to how many positions you can trade. The markets you want to trade, 1, 2, or all. You can trade long or short only, or take both signals. If we're feeling that the market is all bullish, I don't want to take any sell signals. You can just turn off the short only and just take long signals only. You have control over which side of the market you want to be on as well. That's kind of a unique function in the market. So for example, that's a great feature for overnight traders who feel, you know what, maybe the S&Ps, if they rally a little higher and generate a sell signal, I want to take sell signals overnight. I don't want to take buy signals. And you know, if you're really an avid day trader or overnight trader, the Euro currencies and Forex traders, that's another feature or function for you guys as well to help you to kind of filter out what side of the market to be on. This product is not just standalone. Not only do we have the training manual out, online video instructions, monthly webinars, and this is kind of a cool thing because new feature updates and free upgrades. Well, one of the new feature upgrades, in fact, I haven't made this announcement. I'm afraid to make the announcement. We just rolled this product out. We already have a new feature update to make it. It's pretty exciting on a trailing stop feature, but I don't want to get everyone excited because everyone that has gotten it already are going to be calling me up tomorrow. But they don't know this, so I'm pretty excited about it. But also, we've offered bonus pre-programmed trading strategy settings. In the past, one of the things that we offered people was the VIX strategy, the Spider strategy, the Bitcoin strategy, which is still a product in the making, but our crude oil strategy settings, which I want to give all my clients first and offer that. Now, we're down to 58 licenses. That's a very important number right there. And the reason we're down to 58 licenses is because we need to limit this due to a possible acquisition that's in the works. I've said this before, and it's very serious. We're saying it again. This version here, we've seen to make some headway, some head strides, but we have permission for the amount of licenses that we agreed that we would only sell, and we have completely everyone that has, and this is only available for TradeStation clients, but everyone who has a TradeStation account, we need to have your TradeStation account, and it's attached to your account. So there's accountability for this. So this isn't going out on the street being mass marketed. And one of the other reasons is because obviously we don't want signals out there all the time. Even though a 5-minute might be different, they're all the same amount of signals. So I want everyone to understand the optimizer allows you to create and be flexible in your own trades. And that's what's kind of cool. Now, many of you have the person's lifetime package. This may seem like a lot, but this is, again, the lifetime package includes our high close, low close doji, the radar screen, the scanners that we have, and then the Algo system, which is $32.97. It's $32.97. You can make a payment. You can make a payment plan. You can give us a call. We have a bundle package discount available. In addition, TradeStation, for people that have never opened a TradeStation account, will give you a commission rebate for all new accounts if you are into our Education and Trading Algo Optimizer program. So that's kind of a really neat way of saying, hey, this is very powerful. I want this, but you know, this is not a small trade. This is kind of a commitment, and that's why, but it's a serious product for serious traders, and I mean that. Many of you have seen me before. You like my work. This is the pinnacle, the zen, the zenith of my career. I am so happy and proud of this product. This is insanity and what it should be about. I mean, this is where I should have had this 30 years ago. TradeStation allowed us to have computer programming and have signals programmed, but this is kind of like developed into not artificial intelligence, but definitely quant and algo strategies of what we would all expect out of a marketplace. Combined with how the market trades, this 24-hour sequence, the products that are new, like this Bitcoin ETF and the VXX product, I mean, this is such a functional, robust product that it allows us to custom tailor still, whether we're trading E-mini S&Ps to gold futures to, you know, our standard stocks such as, well, I don't know if Amazon is standard, but standard stocks and high velocity momentum trades like a Tesla, for example. So it's kind of a robust product that I think everyone, if you're interested in this, you get a hold of us. Also, as a public service announcement, we will be hosting here in Florida a 3-day investment seminar for active traders. The focus is, of course, algo trading. My friend Dr. Jeffrey Scott will be down presenting his take on trading stocks and equities, also using our radar screen and as well as my indicator package. And so it's going to be a super event. We've got some fund managers that are being in attendance, and I think there's a couple guys that are just, I respect a lot, that are willing to even learn more and heighten their education. So it's going to be a really fabulous event. So I'm looking forward to it. Also, in addition, many of you might be out in Las Vegas at the Traders Expo. I look forward to seeing you out there.